once we've defined that trend, and let's and we've figured out that volatility, and we've drawn our line across and said this is the point at which our original stop loss falls away, and now our trailing stop loss kicks in. At that point, just can you explain through again just how that trailing stop loss works?
Okay, so what you've got is you've got your, it's time to adjust your stop.
Yeah.
And you know that because the horizontal line has intersected the lower edge of long-term GMMA.
Yes.
So you draw a vertical line to the upper edge of the long-term GMMA. That gives you the amplitude. That's how much you need to adjust your stop line.
Ah,
and it sits there. This projection tells you how long that stop needs to be in place.
Yeah.
So with a countback line or ATR, for instance, you may be changing your stop every 3 or 4 days. With TVL, you may be changing your stop every 6, 10, 12, 15 days.
Yeah.
Because although price has done this, the trend is still stable.
Yeah.
You're measuring the trend, not the price. That's the key difference.
I'm going to have to look at that on the DVD. That was Trend Volatility? Was
Trend Volatility, it's a TVL DVD, yeah.
Excellent, I'll have to check that out.
There's a lot more to do. I mean, we originally developed it for short-term intraday trading.
Yeah.
And
to reflect the current climate.
To reflect what was happening in 2008. Because 2008 was an interesting learning experience for lots of us.
Yeah.
A lot of people just lost money in 2008 and didn't learn anything.
Yeah.
That's not good. You can lose money, that's okay if you learn.
Yeah.
And TVL came out of that particular process. What we found is that first that we were using it on index trading on short-term basis, 1 minute charts, that we could then improve our exposure by capturing the trend by shifting 3 time frames higher. So we apply it to a 3 minute chart and verify our exit signals on a 1 minute chart against a 3 minute chart. That put us into longer term trends. But then we found that we could change that in from a 1 day trade into multi-day trades. We also found that we could apply that to an end of day chart. In other words, where each candle represented 1 day rather than 1 minute or 10 minutes or whatever. So for instance, let's take a stock we're trading in Singapore at the moment. Using the techniques I've just discussed, we got into that particular trade. We used TVL as our trend management method. That's currently sitting on 150% return, and that's been an open trade for the last 6.5 months.
Yeah.
And it gives us, and that's had tremendous volatility in price, which has given many false shakeouts. But we're still sitting there because we've defined the trend. But the key factor is the trend volatility line does not define the trend, it defines how we manage the trade based on our entry point.
Yeah.
So it's not an objective definition of the trend, but it is an objective management of our exposure. So if you enter at $1, your TVL will be in a different position than if I enter at $1.10. But it's still valid. It still gives us a way to understand the trend volatility, not the price volatility.
Monitoring that volatility and basing your system around that makes so much sense, because obviously when the market is more volatile, you need to give the stock more room to move, and as it starts to compress, that's logical. That's when you want to be tightening everything in. So we really talked through, I think, from pretty much from start to finish how you would design a trading system, and we talked a little bit about the back testing as well, which is more you do it over sort of the last 12 months. When you know traders out there are in their sort of system design process and they're going through, what sort of characteristics should they be looking for? So okay, they're mapping out this strategy. What sort of drawdown, you know, how many sort of strings of losses, and like is there sort of even some ballparks?
There's no ballparks. And I'll say that for the simple reason that each of us has a different appetite or capacity for risk. Yeah. So you have what I call a freeze or a flinch point, which I've written about in Better Trading. If you can't stand on the bridge out here and throw away $2,000 and not flinch, then you can't trade with a stop that's going to lose you $2,000. You all have a different capacity, and when you first start trading, often you're coming in with limited amounts of capital, and each dollar is pretty precious. So if you can't really come to grips with the idea that you've just lost $1,000, then if your stop is set where you're going to lose $2,000, then you're not going to act on it. Yeah. Doesn't matter what your systems testing does. Doesn't matter what all of your research does. The reality is, when it comes time to act, you will not act. So you must decide, you must discover as quickly as possible what your flinch point is. Now, your flinch point is $1,000. Then when you enter your position, you need to make sure that the maximum loss that you're going to incur is less than $1,000. Otherwise, you won't act.
Yeah, yeah.
Even though technically, theoretically, on the spreadsheets, it's all correct.
Yeah, yeah.
So you need to adjust. And as your trading becomes more skilled, as you have more success, then your flinch point will grow larger.
Yeah.
So you'll get to the stage where $2,000, it's neither here nor there. $20,000, well, yeah, it's not a big problem.
Yeah, yeah, yeah.
But if you start off with the theoretical results and find you can't act, that's when you've got problems.
And start where you are. Excellent. I feel like we've talked through that system design really well. We might shift gears slightly, and I've just got a few other questions if I may. We talked a little bit just at the start of our interview here about where you saw the current climate and how you imagine things developing. And I know you do a lot of work over in China, and China is a great leading indicator and sort of barometer on what's going to happen in the rest of the world, as are some of the other emerging economies. But China's really, I think, at the front of that. Where do you see, like, I mean, we've just had the market get smacked, the market has bounced back almost just so strongly. What are your feelings on where the market will head, the current climate as you see it?
There's a ghost in the room. The ghost is 1930. It's the worst year. Okay, the market collapsed in 1929. In 1930, the market staged a 47% recovery.
That sounds familiar.
And then it collapsed and made new lows. And then it recovered again. It made another 27% recovery. The low point of the market is not 1930, not 1929, not 1928, but 1927. Okay, we think it just went, that was it, but in fact it continued to fall with major rallies in that process. If you take the peak in 1929, that peak in the Dow was not achieved again until 1954.
Wow.
So, yeah, you're in the market for the long term. Yeah, well, this is a generational thing, several generations
but the markets always go up, Daryl.
And that's still measuring the winners. Yeah. So that's a ghost in the background that says this could be, and there are people like Mark Mobius and others are saying this potentially could be a bear market rally, a prolonged bear market rally.
Yeah.
And that's a
with
possibility.
The stimulus as well. Like, I mean, there's...
But in the Depression, people did the same sorts of things.
Yeah.
Not to the same extent, but there are all sorts of factors. And the best stimulus in following 1930, in fact, was World War II, because you had this massive ramp-up of production.
Nothing like water.
It's a consumer-led recovery because everything is instantly destroyed and must be replaced. Planned obsolescence at its best. So, and that's what really dragged the markets out of the Depression period. So, that's the ghost in the room. On a very broad strategic level, we're looking at. There is that possibility of a major retracement, but things are different. They always are.
Yeah.
History repeats, but never in quite the same ways. So that's what makes China interesting, because of the correction in price, that rapid fall, 10-15%, and the correction in time that takes us back to the underlying trend. So that's what we're looking for in US markets, in our markets. So we look at Korea, Kospi, for instance. The Kospi, China can't be traded by people outside of China. It's only restricted to domestic trading. So if you look outside of China, you look at Kospi, and the Kospi is the leading market for behaviour that we see in the rest of the world. So if you look at the Kospi breakout, you had this downtrend, you had this equilateral triangle that developed, and then a breakout from that. Kospi led that. Korea did that first. Then it developed a trading band. The breakout from the trading band, you projected up once, it hit that target. You projected up twice, it hit that target. The same happened in the Sensex and the Nifty, STI. You saw it to a lesser extent in the US, but the rest of the markets outside of the US are following this behaviour. So is Australia.
Yeah.
We are now sitting at the top of that third band.
Interesting.
So what we're doing is watching what's happening in Korea, because that Korean market behaviour gives us a reliable leading indicator as to what's likely to happen here. So when Korea goes down, for instance, hits the bottom of that current trading band and sits there, that's the sort of behaviour we're likely to see repeated here. And John Murphy wrote intermarket technical analysis. And he was looking at relative between platinum and gold and so on and so forth.